Hello everyone, this is Troy Eckard, CEO of Eckard Land and Acquisition here in Dallas, Texas. I'm giving you a market update for September the 23rd, 2021. One of the things I want to point out is that all of my information that I give you is purely my own personal opinion, and I'm giving it to you based on a multitude of factors. I'm in the pipeline business, I own oil and gas mineral rights, I'm involved in oil and gas exploration, and I offer you 36 years of being in the oil and gas space since 1985. That being said, I have my own personal opinion based on all those intricate markets being kind of combined into one analysis. And today we're looking at crude oil prices rallying back from yesterday's low of $70 and some change, actually dropped down to $69 during the trading hours. But we're back up almost to $71 and maybe 50 cents as of early this morning. Natural gas is still hanging tight at about $4.80 per MCF based on Henry Hub pricing. Now, for most of you who follow commodity prices, you may be wondering, well, this is like watching a boxing match one punch at a time. Is it better to watch it round by round? Is it better to watch it day by day? Or is it better to even take a further step back up the ladder and look at it more from a quarterly or annual review? In my view today, we have a lot going on that requires pretty much a week-by-week analysis. Here's why. You would think that as commodity prices continue to increase, that the exploration or the E&P side would be adding more drilling rigs in key areas to supply more natural gas and more crude oil. But the underlying component to much of what's taking place is all being driven by capital or lack of capital. So as we start to see consolidations where Shell decides to sell out their Permian Basin assets for over $9 billion to ConocoPhillips, as we see a continuation of bankruptcies, this week I bet I've seen 5 to 7 new bankruptcy filings this week alone. It tells me we still do not have a bottom to the trough of what's taken place over the last 24 months in oil and gas. So oil prices and gas prices are responding in kind to a derailment of the supply side, a prolonging of new wells being drilled, more wells being drilled, and additional supplies being ready to be put online in the next 12 months. That combination with disruption in the Gulf of Mexico due to the hurricanes of a week or two ago, and the fact that we're now seeing consumption across the globe, specifically here in the United States, back up to pre-COVID levels. So what do we have going on? We've got a market that's reacting. The market is saying, look, we know today we have enough. We know maybe in 3 months we have sufficient supplies. We're thinking we're not going to have enough supply in 6 months to 12 months. We know we're not going to have enough supply in 12 to 24 months. And so traders are taking positions today, securing those balance sheets, securing those barrels and those MCF of gas they need for their downstream customers in order to lock in prices. Now, one thing you got to keep in mind, many of these oil and gas exploration companies also were forced to take hedges last year as prices rallied. Their bankers, their lenders, their financial providers required that those particular exploration companies start locking in some of their producing assets, some of their production levels by hedging. And those hedges were between $50 and $55 per barrel of oil. So today, some of that drilling that we need is being subdued because those particular oil companies are not seeing the same revenue those that didn't hedge are getting. In other words, if I'm selling into the free market at $71, that's great. If I locked in my hedges, some part or all of my production, I'm still only getting $50, $55 a barrel. So we have this pent-up desire, this pent-up cash flow requirement to expand the E&P or the drilling side of the industry. Not going to take place till probably March, April, May. So I would expect next year in 2022 maybe an increase of up to 100 drilling rigs because free cash flow will be much higher as commodity prices go up and hedges come off. Today, September 23rd, my prediction stays about the same as it was last time I spoke to you. I still believe crude oil prices will end up in the year closer between $75 and $85 a barrel with about a 25% probability it will be over $80 a barrel. I still feel increasingly confident that natural gas prices will be $5 to $7 per MCF through winter, meaning starting sometime in November through the end of March. We're going to see really, really high gas prices compared to the last 5 to 10 years because of two factors. Associated gas with oil wells is not there. As production for oil came down and lack of drilling occurred, that associated gas volumes are also down. Plus, we just simply haven't seen the increase in drilling rigs. Think about it. We got $5, almost $6 gas 2 weeks ago. We added only 1 or 2 drilling rigs. That tells you the industry, the engine that's going to replace those declining gas reserves is not in place. Those engines aren't running, which means increased demand, colder weather, not enough supply. We have all the makings for a fantastic gas market going into 2022. Hey, this is Troy Eckard. I'm the CEO of Eckard Land and Acquisition out of Dallas, Texas. I hope you appreciate the insight. You're always welcome to your own opinion. This is just a guy in the field on the ground for 36 years. Thanks a lot.